When it comes to borrowing money, the interest rate that we pay has a lot to do with the risk that the lender has in providing us with that money. So for example, if we're borrowing money against a credit card, where the credit card company is lending us money to buy clothing and food, then they're going to charge us a very high interest rate for a number of reasons. The first being that they don't really have any recourse in case we default on that debt. In other words, they have very little that they can go after, although they have some recourse. In terms of assets, there's very little that they can go after that the money has been used to purchase. And although they can seek to reclaim some of the funds, the reality is that the assets that were created based on that lending are often very close to worthless once they're bought, particularly obviously if it's food that's consumed. But even clothing, as soon as we walk out the store, it can never be resold in most cases for anything near what we paid for it. So credit card companies, to cover this risk and to cover the fact that there are losses associated with this type of lending, charge much higher interest rates. Now, if a company is going to lend against a house and lend a small percentage of the value of the house, and the house is appropriately valued and properly valued, and it can be sold, then the interest rate is going to be much, much lower, because they're lending against an asset that they can go after and effectively foreclose on in most countries, meaning that if we don't make the payments, they can take the asset, sell it, and reclaim the money that was lent to us. Now, if we think we can make the payments on a house or on any other asset, even a car, then it is much better to lend against, to borrow against assets than it is to borrow on a credit card, for example, because it allows the interest rate that the lender provides to be much, much lower. Now, in general, we have to be very careful with debt anyway, and it makes sense to look very carefully at what it is that we're doing with the money, because, for example, the thing that's most certain about any debt is that we're going to have to make interest rate payments. And if those interest rate payments are of the order of 15 to 20%, it's highly unlikely that we're going to be able to find anything that we can buy or invest in that's going to give us a return that's higher than that on a guaranteed basis. Of course, we might have an expectation that we could make more money with that money than 15 to 20%, but there's a very big difference between an expectation and a reality. And the reality is that an interest rate of 15 to 20% is quite stifling and allows the debt to grow very, very quickly. So the first point is that if we borrow against assets, we can significantly reduce our interest rate payments typically, bearing in mind that if we don't make payment, the reason that the interest rate payments are lower is because typically the lender can take the asset away again. And so the key is to be able to borrow prudently and in situations where we feel we can make the payments. And the second thing is to be very aware of borrowing money in situations where we may have an expectation that we can do more with that money than we're having to pay for it, which is very, very difficult in some cases, particularly if the interest rates are very high and there is a reality of a high 15 to 20% interest rate payment, and we only have an expectation of perhaps gaining a return that is comparable or higher, which in most cases is very, very unlikely.